So in the exact same 24-hour window
Right.
that the S&P 500 closed at this unprecedented historic high, the world's most critical oil transit choke point was, well, it was effectively severed.
It's a completely jarring juxtaposition.
Yeah.
We're basically witnessing a massive structural repricing of risk, like in real time.
Absolutely.
I mean, the market had priced in this reality where software and, artificial intelligence just operate in a vacuum, completely immune to the physical constraints of the planet.
Right.
And today's data just shatters that illusion.
It really does. And for you listening at home, we have a towering stack of primary sources to get through today.
So much data.
Yeah, we're looking at fresh SEC 8K filings, specifically a deeply complex, almost contradictory earnings report from Intel.
That one is fascinating.
We also have alternative data sets tracking institutional block purchases. We've got macroeconomic data on the Treasury yield curve, and of course, real-time reports from the commodities markets. So the mission for today's deep dive is to basically synthesize all of this and answer one big question for you. How does a market trading at absolute peak valuation hit a sudden systemic wall?
Yeah.
And maybe more importantly, where is the smart money fleeing to in the aftermath?
Well, the overarching theme you'll see in the data is this massive migration of capital.
Right.
The abstract is rapidly losing its premium. And the physical-like hard infrastructure, raw commodities, silicon manufacturing, that is where the defensive capital is moving.
Okay, so let's start with the immediate market reaction because the surface numbers are highly deceptive here.
Very deceptive.
Just yesterday, the mood on Wall Street was totally euphoric. The S&P 500 hit that closing high of 7,137.90.
Yep.
But today, the momentum just snapped. The S&P fell 0.41% to settle at 7,108.40.
And the Dow dropped 197 points.
Right. And the NASDAQ, which is heavily weighted toward mega-cap tech, obviously, it slid 1.2%.
Which, on paper, a 0.5% drop for the S&P is just daily noise.
It's a rounding error.
Exactly. It's a rounding error. But if you look under the hood, if you really look at the market internals, the plumbing is totally backing up.
So let's talk about market breadth then.
Right. Because the surface numbers completely mask the deterioration of the foundation. The percentage of S&P 500 stocks trading above their 50-day moving average slipped violently today. It went from 60% down to 52% in a single session.
Wow. So even as the headline index hovered near an all-time high, nearly half the companies in that index are fundamentally broken on a technical level.
Yeah, they're trending downward.
That's crazy.
And this divergence is captured perfectly by the performance of the S&P 500 equal weight index.
Right, because the standard S&P 500 is market cap weighted.
Exactly. So if a few $3 trillion companies like Apple, Microsoft, NVIDIA, if they have a decent day, they drag the entire index higher.
Even if the other 495 companies are just bleeding out.
Right. Passive ETF flows just blindly by the index, disproportionately funneling capital into those mega caps. But in the equal weight index, the smallest company by market cap has the exact same gravitational pull as the largest.
And how did that index do today?
It ended the session completely flat.
Wow. Okay, let's unpack this. I look at this market structure like a load-bearing architectural design.
Okay, I like that.
It's as if you have this massive 80-story skyscraper. The penthouse suites, the mega-cap tech stocks are being heavily reinforced with steel, right? They're drawing in all the capital and attention.
Right.
But down on the bottom 40 floors, the concrete is spalling, the rebar is rusting, and the structural integrity is totally compromised. The overall height of the building hasn't changed, so from a distance it looks magnificent.
Yeah.
But the fragility is extreme. If the wind blows too hard at the top, the base just cannot support the sway.
That structural fragility is exactly the key here. When a market rally is this hyper-concentrated, it loses all of its internal shock absorbers.
It becomes super vulnerable.
Acutely vulnerable to idiosyncratic external shocks. I mean, active managers have clearly been distributing their shares, quietly selling off the broader market into the strength of the index because they see the macro deterioration that the passive flows are just ignoring.
And today, that external shock arrived. The wind hit the top of the skyscraper and it blew in from the Middle East.
Right.
Based on the geopolitical reports in our stack, the Iranian Navy has seized multiple commercial vessels.
Which effectively blockades the Strait of Hormuz.
Right.
And the Strait of Hormuz is the absolute jugular of the global energy market. It's this narrow waterway between the Persian Gulf and the Gulf of Oman, and roughly 20% of the world's daily oil consumption passes through it.
That is massive. Now, before we analyze the market pricing, we need to strictly outline the political and military facts on the ground as detailed in our sources.
Yeah, just the facts.
Right. And to be clear to you listening, we're not taking any political stance here. We're just impartially reporting what the sources say. So, U.S. President Donald Trump has ordered the Navy to target any vessels suspected of laying mines in the strait.
Right. And running parallel to this military escalation is a diplomatic track.
Yeah, a ceasefire deadline has been formally extended to allow for intervention by Pakistani leaders. Furthermore, U.S. Vice President J.D. Vance has placed his planned visit to the region on hold, given the fluidity of the situation.
Those are the unvarnished facts as reported. Our focus is purely on how the algorithmic trading desks and, the commodity houses are pricing this new reality.
And they're pricing it with extreme, indiscriminate aggression.
Completely.
I mean, the immediate tangible impact is staggering. Brent crude, which is the global benchmark, climbed nearly 3.4% to $105.94 per barrel. And West Texas Intermediate jumped 4% to $96.69.
But, those futures prices, the 105 and the 96, they almost feel detached from the actual physical panic.
So?
Well, if you look at the spot market, it's a completely different universe.
Okay, break that down for us.
The futures market is merely a financial derivative, projecting months into the future. It assumes some level of eventual normalization, right, or some diplomatic resolution.
Right.
But the spot market, which is the price a refinery must pay to take physical delivery of a barrel of crude tomorrow, that is flashing code red.
Wow.
Spot benchmarks like North Sea Dated are currently trading near $130 per barrel.
Wait, really? 130?
Yes. That is roughly a $60 premium over pre-conflict levels.
That is wild. That structural disconnect between spot and futures implies a brutal backwardation in the oil curve.
Extreme backwardation. It basically tells you that the immediate scarcity of the physical molecule is so severe that buyers are willing to pay massive, uneconomical premiums just to keep the refineries running today.
Because they don't believe the oil will be there next month.
Exactly.
And the data from the International Energy Agency, the IEA, it validates that panic. According to them, global oil production plummeted by 10.1 million barrels per day in March alone.
10 million barrels a day removed from the global balance. You just cannot replace that volume.
Really? Not even with spare capacity?
No. The global spare capacity, even if tapped entirely, cannot plug a 10 million barrel hole overnight. It takes weeks for very large crude carriers to reroute around the Cape of Good Hope. And that's assuming you can even source the alternative barrels.
Right.
Plus, maritime insurance premiums for the region have totally exploded, rendering some shipping routes completely uninsurable.
Which explains why the IEA had to completely capitulate on their economic forecasts.
Oh, absolutely.
They went from projecting global oil demand to grow by 730,000 barrels per day in 2026 to now projecting a contraction of 80,000 barrels per day.
It's a massive swing.
But I want to dig into the mechanics of that contraction because oil is inelastic in the short term, right? People still need to commute, ships still need to move freight, data centers still need diesel for backup generators. How does demand actually contract so violently?
Well, it contracts through the brutal mechanism of demand destruction. When supply vanishes, price must rise until it basically forces consumers out of the market. A $130 spot price for crude translates into massive spikes in diesel and jet fuel.
Right.
And this creates what we call oil inflation, which acts as an unavoidable, immediate, and highly regressive tax on the global economy.
So it bleeds into every single layer of the supply chain.
Exactly. Think about the trucking company paying $6 a gallon for diesel. They cannot absorb that margin hit, right? So they pass it on to the retailer.
And the retailer passes it on to the consumer.
Yep. The consumer's discretionary income just evaporates, so they stop buying goods.
Yeah.
Factories slow down production because inventory isn't moving, which means they lay off workers, require less electricity, fewer raw materials.
It's a domino effect.
Ultimately, the economy decelerates to a point where it simply demands less oil because it fundamentally cannot afford it. The high price cures the high price by suffocating the broader economy.
So what does this all mean for the tech industry? I look at the broader tech sector, and the assumption for the last decade has been that Silicon Valley is largely insulated from this.
Right. That's the narrative.
Yeah, like surely software companies sitting in Silicon Valley are immune to the cost of physical barrels of oil, right? If you sell cloud-based software, your gross margins are 85%. You aren't operating a fleet of diesel trucks.
Right.
But today's market action implies that the contagion has officially breached the walls of the software industry.
Yeah, the tech sector operates under this delusion that it floats above the physical economy.
Yeah.
It doesn't.
No.
Software revenue is entirely tethered to the capital expenditure and operational budgets of its customers. To understand the vulnerability of software, you really have to look at the companies burning the physical fuel first.
Which brings us to the airlines. They're the ultimate tip of the spear for energy shocks. Let's look at the earnings from American Airlines.
Okay.
The top-line numbers look phenomenal. They reported record first-quarter revenue of $13.9 billion, up 10.8% year over year.
So the demand for travel is there.
The demand is definitely there. But despite that record revenue, they posted a GAAP loss of $382 million and an adjusted net loss of $267 million.
It is a textbook illustration of top-line growth being entirely consumed by exogenous input costs.
Yeah.
I mean, they cited a $4 billion increase in fuel expenses.
$4 billion.
$4 billion in margin, completely eradicated by the energy shock.
I do want to quickly contrast that, though, with United Airlines. They reported a $699 million GAAP profit in the exact same macro environment.
Yeah, that's fascinating.
It suggests a massive divergence in operational strategy.
The disparity likely comes down to their respective hedging books.
Right.
Airlines use complex derivatives like call options, futures contracts, to lock in fuel prices months or years in advance. If United hedged heavily when oil was at $70, they're insulated from the spot market spike to $130.
Whereas American might be heavily exposed to spot pricing.
Exactly. But, hedging is a temporary shield. Eventually, those contracts expire and the entire industry is forced to roll over into the new hyperinflated price environment.
So imagine the psychology of the C-suite at American Airlines right now, or any Fortune 500 company facing a sudden multi-billion-dollar hit to their logistics and energy costs. You are the CFO. Your operating margins are collapsing. What is your immediate reflexive action?
You implement an immediate freeze on operational expenditures.
Right?
You halt hiring, you delay capital projects, and you ruthlessly audit your recurring software licenses.
And there it is, the transmission mechanism from the Strait of Hormuz straight to Silicon Valley.
Yep.
When corporate budgets are violently squeezed by inflation, the fat that gets trimmed first is speculative enterprise software, which explains the absolute bloodbath we saw in the AI software sector today.
Oh, it was brutal.
Let's examine ServiceNow. They trade under the ticker NIW. The stock plunged as much as 19% today.
A 19% drop for a large-cap enterprise software company, that is a catastrophic repricing of future cash flows.
And the irony is, their underlying metrics didn't even look that bad at first glance. They reported 22% year-over-year subscription growth.
Right, which is solid.
Historically, Wall Street would reward 22% growth with a massive multiple expansion, but the market punished them mercilessly because management admitted on the call that large enterprise deals were being delayed.
And why were they delayed?
They explicitly blamed the macroeconomic uncertainty stemming from the Middle East conflict.
See, this signals a definitive psychological shift in the market. We have officially entered the show me the ROI phase of artificial intelligence.
Right, the return on investment.
Exactly. For the past 2 years, the deployment of AI software was driven entirely by FOMO, fear of missing out.
Oh, totally.
Corporations were blindly signing these multi-million-dollar contracts for generative AI tools, copilot software, predictive analytics, without any rigorous framework for measuring the return. They just knew they couldn't afford to be left behind.
But the luxury of blind investment evaporates when oil hits $130.
Precisely. When your core operational costs are exploding, you cannot afford to beta test speculative software. CFOs are demanding clear, immediate, high-margin monetization.
Right.
If a software contract does not demonstrably reduce headcount, lower physical operating costs, or dramatically increase revenue today, it just does not get signed. The sales cycle elongates from 3 months to 12 months.
And the contagion was broad, too. IBM fell between 7 and 10% on uninspiring guidance. Salesforce dropped nearly 9%.
It's sector-wide.
Here's where it gets really interesting. It reminds me of household budgeting during an inflationary spike. Like when your winter heating bill doubles and your grocery bill goes up 30%, you don't cancel your mortgage payment or turn off the water.
Right. You keep the vital infrastructure running.
Exactly. But you absolutely go through your credit card statement and you cancel that premium language learning app or the high-end fitness subscription you bought 6 months ago and haven't really figured out how to use yet.
That's a great analogy. Enterprise software is the premium fitness subscription of the corporate world right now. It's nice to have, but it is totally discretionary when survival is on the line.
But here is the massive contradiction in the market today. While the software layer is facing intense scrutiny and brutal margin compression, the companies building the physical foundation of AI, the hardware and semiconductors, they're telling a completely different, wildly successful story.
Right, because you cannot delay the physical infrastructure if you intend to participate in the digital economy over the next decade.
Makes sense.
Software can be optimized or delayed. Silicon is finite and mandatory.
So let's look at the resilience in the semiconductor space. Texas Instruments surged between 10 and 19% today on a massive earnings beat.
And they are essentially a bellwether for the broader industrial economy.
Right, because their analog chips go into everything from automobiles to factory automation. ST Microelectronics also reported a 23% revenue increase, hitting $3.1 billion, driven by AI data centers and EV architectures.
So the capital is bypassing the application layer and flowing directly into the bedrock.
Exactly. But the primary focus here, the most complex, fascinating piece of data in our entire stack, is the Q1 2026 SEC 8K filing from Intel.
Oh man, the headline numbers on that are aggressively contradictory.
Super contradictory. It requires a forensic reading to understand what management is actually executing here.
It really is a masterclass in balance sheet reconstruction.
Let's break down the incredibly complex financial results. Top line, revenue reached $13.6 billion, representing a 7% year-over-year increase.
Okay.
The stars were clearly defined. Data center and AI revenue rose 22% to $5.1 billion. The Intel Foundry division hit $5.4 billion, up 16%.
So the core business of designing and manufacturing physical chips is seeing robust demand.
Right.
The demand signal is undeniable. The geopolitical premium placed on domestic semiconductor manufacturing is finally translating into top-line revenue for Intel's foundries.
But then you look at the ugly GAAP numbers. Under generally accepted accounting principles, they reported a massive net loss of $3.7 billion and a diluted earnings per share of negative 73 cents.
It's a bloodbath on paper.
It is. But right next to those numbers, you have the pretty non-GAAP numbers. Non-GAAP net income was a positive $1.5 billion with diluted EPS of 29 cents, which absolutely smashed the Wall Street estimate of a single penny.
That is a $5.2 billion swing between GAAP and non-GAAP net income.
Crazy. So explain the difference here for the listener.
To understand this, you really have to understand the latitude management has in financial reporting. GAAP is the rigid, standardized accounting framework mandated by the SEC.
Right.
It requires a company to report every single cost, including massive, non-recurring penalties or asset write-downs. Non-GAAP, on the other hand, is an adjusted metric where management is legally permitted to exclude certain one-time charges.
To give investors a clearer view of the underlying business.
Exactly, to show the recurring operational profitability.
And Intel management excluded a mountain of charges this quarter. Unpack the massive $4.1 billion in restructuring and other charges for us.
Right, so the composition of those charges is really telling. A significant portion was a goodwill impairment related to their Mobileye unit.
Okay, let's drill into that. Goodwill is an intangible asset that gets recorded on a balance sheet when a company acquires another company for a price higher than the fair market value of its net assets, right?
Trike.
It represents brand value, intellectual property, or expected synergies.
Right. And an impairment means Intel's management, led by CEO Lip Tan and CFO David Zinsner, they formally admitted that the premium they paid for Mobileye years ago is no longer justified by its current standalone value.
Oh, wow.
Yeah, so they had to take a massive accounting loss to write down that asset. Importantly, though, an impairment is a non-cash charge.
Right.
It destroys book equity, it makes the GAAP net income look catastrophic, but it doesn't actually burn cash from the Treasury.
Got it. And the other massive charge was $1.09 billion in mark-to-market losses on something called escrowed shares.
Yes.
According to the filing, these are Intel shares held by a third party, which are slated to be released to the U.S. Department of Commerce in connection with funding from the CHIPS Act Secure Enclave Agreement.
This is a really fascinating mechanism of industrial policy. The U.S. government is effectively taking an equity-like position or securing collateral in exchange for billions of dollars in CHIPS Act funding.
Right.
Because Intel's stock price fluctuates, the value of those locked-up shares fluctuates, and GAAP requires them to record that mark-to-market volatility on the income statement every single quarter, even though no shares have actually been transferred.
Again, it is a paper loss that obscures the operational performance.
Exactly.
Okay, let's unpack this GAAP versus non-GAAP thing. It's like flipping a house, right?
Yeah.
You take a massive, painful, one-time financial hit to renovate the kitchen and fix the roof. Those are the restructuring charges. It makes your current bank account look terrible.
Right.
But once you strip out those one-time costs, your underlying rental income, the core business, is actually booming. And if you strip away the $4.1 billion in restructuring, the goodwill impairment, and the mark-to-market paper losses, the core engine of Intel looks radically different. Their non-GAAP operating margin expanded from an anemic 5.4% last year to a very robust 12.3% this quarter.
It looks like a classic kitchen sink quarter.
Kitchen sink.
Yeah, management is taking all the pain, all the write-downs, and all the restructuring costs simultaneously. They are clearing the decks. They're basically saying, why are we taking the pain now to reset operations?
This turnaround story sounds great on paper, but is anyone actually buying it? Let's follow the smart money.
Okay.
Let's introduce the alternative data from Quiver Quantitative to see how insiders and institutions are trading Intel.
The insider trading activity presents a fascinating divergence in executive psychology.
Right, because we see conflicting signals. The executive vice president and chief legal officer, Boise, sold 20,000 shares for roughly $981,000.
Well, insider sales are common, and they often lack predictive power. Executives sell to pay tax liabilities, purchase real estate, or just diversify heavily concentrated portfolios.
Yeah.
It doesn't necessarily signal distress.
But the buy side of the ledger is what caught my eye. The chief financial officer, David Zinsner, the architect of this $4.1 billion restructuring, he actually purchased 5,882 shares on the open market with his own capital.
Right, roughly a $250,000 investment.
Exactly.
There's an old adage in finance, insiders sell for a dozen reasons, but they only buy for one. They believe the equity is undervalued.
Right.
The CFO deploying personal capital immediately after taking a massive GAAP loss is a very powerful signaling mechanism to the market.
But a $250,000 insider buy is a footnote compared to the institutional blockbuster data we uncovered.
Oh, this is massive.
This is arguably the most consequential data point in our entire analysis today. In the fourth quarter of 2025, NVIDIA Corporation added 214.7 million shares of Intel to their portfolio.
An allocation of that magnitude is just paradigm shifting.
We are talking about an estimated capital deployment of $7.9 billion. NVIDIA, the undisputed king of AI GPUs, took an almost $8 billion equity stake in a company that the financial media routinely frames as their direct competitor.
Yeah, the media narrative of a zero-sum war between NVIDIA and Intel has always been technically illiterate.
Right.
The reality of semiconductor architecture is highly symbiotic, and the business highlights in Intel's 8K prove it. Intel explicitly announced that their new Xeon 6 processor was selected as the host CPU for NVIDIA's next-generation DGX Rubin NVL8 systems.
If we connect this to the bigger picture, what does it mean when NVIDIA buys nearly $8 billion of Intel stock? I think we need to dive deep into the architecture of an AI data center to explain why this relationship exists.
Let's do it.
NVIDIA designs the GPU, the graphics processing unit. The GPU is the brute force computational muscle required to train massive large language models. It handles parallel processing natively,
Right.
but a rack of GPUs cannot function autonomously. They require a manager to direct traffic.
They require a host CPU.
Right. The CPU handles the sequential logic, the operating system, and the incredibly complex data input-output routing. If the CPU creates a bottleneck, the GPUs sit idle, waiting for data.
And in an AI data center, an idle GPU is burning millions of dollars of potential compute time.
Exactly. The architecture relies on incredibly fast data transfer standards like PCIe Gen 6 lanes and Compute Express Link memory controllers. NVIDIA chose Intel's Xeon 6 because it provides the necessary I/O bandwidth to keep their Rubin GPUs fully saturated with data.
It is an architectural necessity. But, the $8 billion equity stake suggests a strategic motive that extends far beyond a simple vendor relationship.
What do you mean?
NVIDIA is looking down the timeline at the geopolitical landscape.
Where?
Currently, NVIDIA relies almost entirely on TSMC, Taiwan Semiconductor Manufacturing Company, to fabricate their most advanced chips.
Right.
TSMC is an engineering marvel, but it is located on an island that is the focal point of extreme geopolitical tension.
Oh, right. If the Strait of Hormuz can be blockaded, the Taiwan Strait can certainly be blockaded.
Exactly. If TSMC goes offline, NVIDIA's revenue goes to zero overnight. By injecting $8 billion into Intel, NVIDIA is aggressively subsidizing the development of a Western, geographically secure semiconductor foundry ecosystem.
So they are effectively paying a premium to ensure they have redundant manufacturing capacity in the United States and Europe 5 years from now.
NVIDIA is buying their own supply chain security. It's a brilliant strategic hedge.
This sounds incredibly bullish, but let me play devil's advocate for a second.
Okay.
Intel's adjusted free cash flow was negative $2.0 billion this quarter. They generated $1.1 billion in operating cash, but they're bleeding cash to build these massive new semiconductor fabs in places like Ohio, Arizona, and Ireland.
Right.
The capital intensity of EUV lithography machines, which cost upwards of $300 million apiece, is staggering. With interest rates where they are, is this massive capital expenditure sustainable? Can any company run a negative $2 billion quarterly free cash flow without eventually hitting a debt wall?
That exact question, the cost of capital, brings us right back to the macroeconomic environment and the Federal Reserve's current nightmare scenario.
Let's examine the U.S. economic indicators from the sources because they are flashing deeply contradictory signals.
Very contradictory.
On the surface, the industrial economy appears robust. April's preliminary Manufacturing Purchasing Managers Index, the PMI, surged to a 4-year high of 54.0.
Any number above 50 indicates expansion.
Right. The services PMI is also in expansion territory at 51.3. Furthermore, the labor market remains incredibly resilient, with weekly jobless claims sitting at a historically tight 214,000.
So the real economy is expanding, labor is tight, and manufacturing orders are increasing.
But the inflation data is just venomous. Core inflation remains stubbornly sticky at 3.3%, well above the Fed's 2% target.
We are witnessing the mechanics of stagflation crystallizing in real time.
Define the current state as stagflation in real time for us. It's a term that terrifies economists, usually implying high unemployment and high inflation. But unemployment is low here.
Right, it's a modern variant of stagflation. The superficial metrics of employment look strong, but the input costs for businesses are rising at their second fastest pace since 2022.
And why is that?
The inflationary spike is entirely supply-driven, stemming from the energy shock in the Iran conflict we discussed earlier, plus the fracturing of global supply chains, the cost of raw materials, the cost of maritime shipping, the cost of physical energy. They're all structurally higher.
Which puts the Federal Reserve in an impossible position regarding their dual mandate.
Explain why the Federal Reserve is trapped.
Well, they are completely trapped by the realities of physical supply. The market widely expects the Fed to hold the benchmark Fed funds rate steady at 3.75% when they meet next week.
Right.
They can't cut rates to spur growth because injecting monetary liquidity into a supply-constrained market will simply cause the inflation rate to explode.
It would go from 3.3% straight back toward 8%.
Exactly. But keeping rates higher for longer creates a vicious negative feedback loop for the very capital-intensive businesses required to solve the supply shortages.
Like Intel's foundries.
Right. If Intel needs to borrow tens of billions of dollars to build the foundries that will secure the tech supply chain, a 3.75% risk-free rate makes the cost of debt financing astronomical. High interest rates choke off the capital formation required for industrial expansion.
It is a total economic catch-22. You need massive physical infrastructure to solve the supply bottlenecks, but the high interest rates required to fight the inflation caused by those bottlenecks makes building the infrastructure prohibitively expensive.
Wow.
And the bond market is pricing in this exact prolonged, agonizing scenario.
Let's look at the Treasury yield curve then. It's the ultimate arbiter of macro truth.
Yep.
Currently, the 10-year Treasury yield is sitting at 4.32%, while the 2-year yield is at 3.81%. That represents a positive spread of 51 basis points.
So the curve is upward sloping, but context is critical here. Historically, an inverted curve where short-term rates are higher than long-term rates signals an impending recession.
Right.
When the curve steepens and becomes positive again, it usually implies that the market expects the Fed to slash short-term rates to stimulate growth.
But that's not what is happening here. The curve isn't steepening because the 2-year is collapsing. It's steepening because the 10-year yield is anchoring at a structurally higher level.
Exactly. The market is demanding a massive term premium to lock up capital for 10 years. A 4.3% yield on the 10-year Treasury indicates that bond traders believe elevated inflation is a permanent structural feature of the next decade.
So they don't believe the Fed can ever return to the era of zero interest rates.
No, because the geopolitical fragmentation and the cost of deglobalization guarantee a higher baseline of inflation.
So what does this all mean for you, the listener? If you're looking at a world of high inflation, expensive software, high interest rates, and geopolitical wars, where do you put your faith and your capital?
Well, investors are increasingly moving their capital out of the abstract and into the physical.
The flight to hard assets and critical infrastructure.
Exactly. It's the defining megatrend of this data stack.
Let's examine the ultimate tail risk hedge, gold. Our sources indicate that gold bullion hit a record average price of $4,673.50 per ounce in the first quarter of 2026.
Wow.
And spot prices are currently grinding higher, trading near $4,738. Obviously, geopolitical fear and central bank buying are driving the demand side, but the supply-side economics are arguably more fascinating.
Yeah, this raises an important question. The supply side actually sets a rigid thermodynamic floor under the price of the asset.
Okay, detail the data point from Newmont Corporation for us. They're the world's largest gold miner.
Right. We analyzed their quarterly data, and their all-in sustaining cost, or AISC, has surged 24% year over year to $1,680 per ounce.
And just to define the all-in sustaining cost, it represents the comprehensive marginal cost of pulling an ounce of gold out of the earth and processing it into bullion.
Right.
It includes the exploration, the diesel for the massive haul trucks, the electricity for the crushing mills, the labor, and the sustaining capital expenditures for the mine site.
See, mining is basically an exercise in applied thermodynamics.
Mm.
You are moving and crushing millions of tons of waste rock to extract a few grams of metal.
It's incredibly energy intensive.
Exactly. As the global energy shock drives up the cost of diesel and power, and as inflation drives up labor costs, the AISC moves mechanically higher. Furthermore, the highest grade ore deposits have largely been depleted. Miners are forced to process lower grade rock, which requires exponentially more energy per ounce recovered.
So that $1,680 AISC acts as a structural floor for bullion prices. If the spot price of gold ever dropped below the marginal cost of production, the miners would immediately halt operations, supply would vanish, and the price would rapidly correct upward.
Gold cannot be conceptually abstracted. It is bound by the physics of its extraction.
And this constraint isn't limited to precious metals used as monetary hedges.
No, it applies directly to the industrial metals required for the AI revolution. Combine this with silver entering its 6th consecutive year of structural supply deficit.
6 years.
Yeah. Silver is the most highly conductive metal on Earth. It is irreplaceable in advanced electronics, heavily utilized in the manufacturing of high-end GPUs, electric vehicle architectures, and solar panels.
So the digital ambitions of the tech sector are violently colliding with the physical constraints of the planet's mineral reserves.
Exactly.
And the realization that digital infrastructure is bound by physical limits brings us to the infrastructure megatrend. We are seeing massive private equity and institutional capital executing multi-billion-dollar acquisitions to control that physical layer.
Right. Let's connect this desire for tangible assets to the tech world.
Let's look at SoftBank Group. Historically, they're known for funding highly speculative, cash-burning software startups. But they just received shareholder approval for a $2.9 billion all-cash acquisition of DigitalBridge Group.
SoftBank isn't buying software anymore. They are buying cell towers, data centers, and fiber.
Right. DigitalBridge is a digital infrastructure real estate investment trust. They own the physical assets.
SoftBank's pivot is highly illustrative of the broader market rotation.
I compare this to the 1849 gold rush. We have moved past the initial phase of investing in the idea or the hype of AI.
The smart money is now buying the pickaxes.
Exactly. The pickaxes, the railroads, and the physical land. The data centers, the silicon foundries, and the energy sources.
It reminds me of the deployment of the first transatlantic telegraph cables in the 1850s. The entities that focused on the abstract concept of instantaneous communication often went bankrupt.
Right.
But the entities that eventually mastered the physical engineering laid the thousands of miles of heavy copper wire and physically connected the continents. They dictated the flow of global commerce for the next century.
That is an apt parallel. The software application layer of artificial intelligence is highly competitive, easily commoditized, and currently facing a severe margin compression cycle. But the physical substrate, that is where the durable monopolies are being forged. SoftBank is basically buying the modern equivalent of the copper wire at the bottom of the ocean.
Exactly.
So let's synthesize the vast journey we've taken today. We started with the stock market stumbling from record highs, traced it back to a physical oil shock in the Strait of Hormuz, watched that shock bleed into corporate software budgets.
And discovered how physical hardware, led by an ambitious Intel turnaround and backed by NVIDIA, is weathering the storm alongside hard assets like gold and data centers.
It is a profound structural rotation from the abstract to the tangible. As we conclude this analysis, let's pivot to the forward-looking implications. Based on this complex web of data, deliver one final thought for the listener to mull over.
Here's the core thesis to test against the market. If the artificial intelligence revolution requires this much physical energy, hardware, and infrastructure, how will the global tech giants secure their supply chains in an increasingly fractured, conflict-prone world? Moving forward, market dominance might not belong to the company with the best software algorithm, but to the company with the most resilient physical power grid and silicon foundries.
A sobering, fundamental reality to end on. The foundation of the digital future requires steel, silicon, and massive amounts of energy, and in a stagflationary environment, those physical inputs are commanding an increasingly steep premium. Thank you for joining us on this deep dive. Keep questioning the headlines, and we'll see you next time.